Markets may be selling off, but a number of stocks still managing to yield some big gains. Bob Pisani is down at the NYSE to break it down. Hi, Bob.
Hi, Melissa. The S&P is down for 7 of the past 8 sessions right now. The market leadership groups like the transports, the Russell 2000, semiconductors, all the industrials, they've underperformed the markets today and really in the last couple of weeks. That's been a big issue for a lot of people. But the debate is about whether this is signaling some kind of broader slowdown. The economic news in China and Europe has not been good recently. Now, some of this may be simple profit taking after most of these sectors rose 20% or more off their December lows. So it's understandable you'd have some profit taking at this point. The important thing is the Treasury yields, a separate story. They're down again today. 10-year yields, 2.6%, sitting right near their lows for the year. Meantime, some very high yielding stocks with dividend yields over 4%. They're doing very well this year, including Cody's up about 70%. Philip Morris is up nicely. Western Digital's up 26%. ExxonMobil's up 17%. General Motors also up. Now, on the surface, this makes sense. With interest rates remaining low, high dividend paying stocks would likely be more in demand among those looking for yields. However, the strategy of buying dividend payers in general this year isn't providing a huge payout. The largest dividend-focused ETF, that's the Vanguard Dividend Appreciation ETF, the symbol's VIG, is up 9% this year. Another big dividend ETF, the Vanguard High Dividend Yield ETF, goes for the highest dividend-paying companies. It's returning about the same, close to 9%. That is about the same return as the S&P 500. This also includes high dividend payers like Verizon, Pfizer, ExxonMobil as well, Johnson & Johnson, and Procter & Gamble. Back to you, Melissa.
All right, Bob. Thank you. Bob Pisani at the NYSE. Well, this sounds like a perfect time to play a game because we haven't played a game since like yesterday. Yield hunting. Here's how the game works. We'll use a name like Exxon up 17% this year with a dividend of 4%. If you're buying that name, you'll see that. Meaning you're hunting for the stock. You like it.
You're hunting.
If you'd rather let it fly away, meaning you do not like the stock, you'll see that duck, that red duck, taking off.
In Guy's defense,
Got it.
it's really confusing.
It couldn't be clearer. A crosshair.
We're going to give this a try.
Duck.
Tim,
okay.
You kick it off. Exxon.
I'm going to, I'll tell you what. So I'm going to hunt it. No, whatever the green one is. I'm going to put it in my scope and do whatever. Anyway, leaving aside, I love the bird, though, but the reason I'm actually going to continue to be bullish on this stock, put it in layman's terms, is because I think the energy sector is going to continue to outperform. The whole issue with Exxon, to me, is relative to their peers in the integrated space, I don't think it's that interesting. But if you listen to their analyst day, which was just a couple days ago, these guys are going to give back $90 billion, or they're going to have $90 billion in free cash flow between 2019 and 2025 at a $60 oil price, which I think we're going to maintain. So I think it's interesting. I think it's outperformed the XLE. It's outperformed the S&P in the last 2 to 3 months.
So, Tim, is that a big part of it? Because, like, to me, I think the crude oil is one of the worst looking charts in the market. And when you look at it where it is relative to where it was just in the fall, I'm just saying it's had this move back.
You're going to let this one fly?
Yeah, I'm letting this one fly. No, but what I'm saying is it contingent on crude oil staying firm in the mid-50s and working its way into the 60s?
Let's put it this way. I think these companies, these integrateds, are being run very differently than they were 5 years ago. So I think there's been a change in approach towards equity investors, not as opposed to debt investors. They're not growing at all costs. Right. So I think the companies run better. I think the entire sector.
They're going to be spending a lot when others are cutting back.
They're going to be spending a lot.
That was their thrust at the investor meeting.
Well, but there's going to be asset divestitures, and you can make an argument that, after you take away some of that stuff, their free cash flow is not going to be all that impressive. I just think that the energy sector, so then to get into the macro call, I do think energy can hold here. I think supply demand right now, I'm not going to tell you where it is in 2 years. I'm going to tell you between now and 9 months from now, I think energy is holding this level.
All right, Karen's next. GM, General Motors, Karen, what do you say?
Yeah. Well, GM, I like GM, but it has nothing to do with the dividend. That happens to be an afterthought. You know, I hate this concept. We looked at like Kraft a year ago. You could have had, or not a year ago, a month ago was paying a 5% dividend.
You killing the bird?
GE, a year ago, 4% dividend.
Hunting
this one, I'm hunting. No, I like GM.
Yeah.
So it's an earnings play. I think they're doing an excellent job. I think clearly people are concerned peak auto and the earnings are going to come down. We've seen that in the multiple, which I think really reflects a pretty dramatic downturn in auto sales.
I think they're doing the right things. I think they've turned a corner for GM on a relative basis. I do agree.
The business or the stock or what?
The business, the stock. I do believe that the stock will come in a bit. And I agree with Karen. You never want to go looking for the dividend, because you could have the stock roll over and you give back whatever yield that you were searching in 1 day, 2 days, 3 days. But this is one that I would hunt, so I would be a buyer of it. Green.
Very nice. All right, Dan is up. Dan knows how to play the game, I think. Yeah. Philip Morris, Dan.
So here's one. When Bob Pisani was kind of giving us that lead and he was talking about how well some of these stocks are acting, I look at a stock like Philip Morris, which is up basically 10% in line with the S&P right here, but it's up 30% from its lows, not its Christmas lows, its January lows. This thing's kept on going down in January for fundamental reasons. So you got a near 6% dividend yield. It trades well below a market multiple. Yeah, there is a little growth there. Cash flow per share is actually going to be declined year over year. I'm letting this one fly. I don't like the relative performance here. Whatever it is, I'm doing that thing.
Come on, man.
I just don't think you trade a name like this, as controversial as it is, in this market. I just don't. And so relative to the fact that it's up 30% from the lows in January, but only up 10% of the year, I don't like it.
All right. Next up, Grasso. Steve, what do you say about Coty?
Well, the reason why the yield is so high in Coty is because it had a string of earnings misses. The stock has been clobbered. The latest pop in the stock was due to a headline that JAB was going to increase its holdings within it, its stake within the name itself. I don't think that this dividend is safe. I think that we're going to have to see what takes place over the next coming months. But if you have a problem with earnings, I don't think you should be hunting for this one. So I would let it fly.
All right. Thank you. Tim?
Look, as much as I love Coty's products, look, I don't love this story at all, so I'm going to let it fly, whatever we're calling that. I'd sell it.
Yeah, let it fly.
Red
tail
duck.
wagging the dog.
The kids today.
Another metaphor.
It's just buy or let it fly.
They're not using the Coty. You know what they're using? The Glossier. .com. They're buying it up. They just had this new launch play. Yeah, I know. The kids are buying it. My kids
Did you run out of yours?
They bought it right away. Glossier Play, new line.
You're glowing today, by the way. You exfoliate before the show?
It's all that bronzer that Dan likes to use.
Nice.
And the Glossier. But in terms of these stocks, what we're saying, I guess, is not necessarily hunt them specifically for the yield, but if you like the fundamentals of the stock, plus you get the kicker of that dividend yield,
right,
that could really help.
That could help. So, right, exactly that. To look at it the other way around, Cody's a perfect example.
Mm-hmm. Right.
Yes.
Don't. And then if you want to go all options action on people.
Yeah.
Should we do that?
Juice the dividend.
Well, listen, there's a lot of things that you can do in a name like Philip Morris. I just think it's really important we talk about the range that it's in. That dividend, you could lose it if you're there for it. You could lose it in a day. So, you know what I mean? But there's also other strategies. You could buy the stock, you can sell out of the money calls, that sort of thing, kind of juice the dividend.
Yeah. How important is dividend to you?
Very little. But I would reiterate what's been said here. Let me throw a name that we didn't have in there. But AT&T. I actually think the fundamentals at AT&T are getting better. That's a monster. That's a monster dividend. I would be hunting. I'd be getting out my scope. There'd be a green thing. Whatever that was. And the reason for that is because this is a company that I think has actually started to divest some of that debt, et cetera. So. Dividend, not critical.
All right. We have a news alert on Fed Chair Jerome Powell. Let's get to Eamon Javers in D.C. for the details. Eamon.
Yeah, Melissa, this is going to be must-see TV. CBS has just announced that Jay Powell, the Fed chair, is going to be on 60 Minutes this weekend in an interview that has already been recorded. CBS saying that Powell sat down with CBS's Scott Pelley this week in Washington, D.C. for what they're calling a wide-ranging discussion that includes the Fed chairman's remarks on interest rates, the outlook for America's economy, and whether the U.S. financial system is vulnerable to cyber attacks. They also say that because the interview is on the comes almost 10 years to the day since Pelley interviewed then Fed Chairman Ben Bernanke during the Great Recession, Bernanke and his successor, Janet Yellen, appear in the interview alongside Powell in one of the interviews for the report to discuss how they advised him to handle the job and the criticism that comes with it. That will obviously be fascinating viewing and so interesting to see whether or not they discuss the criticism from here at 1600 Pennsylvania Avenue from the President of the United States, who has been very critical of Jay Powell's approach to handling interest rates at the Fed. We'll see whether they get into that at all in the interview. But that news just breaking within the past couple of minutes there, Melissa.
Wow. Eamon, thank you. Eamon Javers joining us from the White House. I don't even know where to go with this because it is so unusual, right, for a sitting Fed chair to do a television interview. This is a Fed chair who has been talking almost nonstop. It has gotten him into trouble.
October 2nd and 3rd were the reason why the market started selling off. He was talking. That's where this to me is unbelievable that he would do this.
It's just the point is why?
Yeah,
why is the acting
this
Fed chairman
point-
going on 60 Minutes? Look, 60 Minutes is going to do everything they can to stir the pot on this. And I don't see why he's supposed to be sitting in there answering those questions. It's not a congressional hearing. It's not Humphrey Hawkins. This guy's the Fed chairman. And I don't think also the way this is interpreted on a Sunday night primetime audience is exactly how it should be interpreted in the context of really talking to people in the Federal Reserve Bank.
Did even say that Bernanke and Yellen would also be?
Yes.
So, I mean, it was what, last week where Yellen was saying, I think that was sort of an interesting quote about that she believes Trump really doesn't understand, I guess, the role of the Fed or what tools it has available, what they could really do. I mean, that'll be interesting. I think they'll probably come back to that, I would imagine.
Given the criticism that he's faced for the same reasons that, that was everybody's first, I have to think this is going to be a very gently planned interview. The fact that Bernanke and Yellen are there, there's not going to be.
You think Scott Pelley's going to ask him about the pivot and
the
markets?
But maybe. But again, like you guys have all said, he's really good with a script. He's going to have a script for this. There's not going to be anything.
He was only good when he was reading off that piece of paper.
He's got to be reading the script.
Right. But listen, we're not going to have the futures down, 10 points at 6:45 p.m. on Sunday night.
But leaving aside why why CBS, outside of nerds like us, why would they even put this on Sunday night primetime? Why do people really care? Why would the Fed chairman go on to 60 Minutes and give detail into anything?
Well, here's a conspiracy theory for you. This is a Fed chairman who has met more times with Congress than any other sitting Fed president during this same amount of time in office. He may be on a public campaign to sort of bolster his support in light of the president's criticism of him.
Look,
does that more allies in Congress as well as in public.
It sounds like the Fed being political. It sounds like the Fed going on a political campaign, which is not what we want.
Okay, let me give you a different conspiracy.
Okay.
That he wants to soothe any fears people have about the economy.
Yes.
Right? So we were going to talk about job growth and how the economy's doing. If that were the case.
Yeah,
I wouldn't love that as much. I don't think that's his job either.
Why does he need to soothe our fears about the economy?
What?
I don't understand why he needs to soothe our fears about the economy.
I don't either. It's just a conspiracy theory that I just worked on just now.
We did have Humphrey Hawkins. He was in front of Congress for what, 2 days last week or something like that. A lot of questions were asked. But at the end of the day, when we came into, at some point in 2018, there was an expectation of 3 rate increases for this year. That is now obviously off the table. There's a 0% chance of that. A lot of people think the next move is going to be lower. I think the notion of him explaining to the American people a very controversial sort of monetary policy, but a very controversial thing, explaining to him, I don't think there's anything wrong with that. I just don't. And I would not expect him to make a big mistake. I would not expect anything to come out that's going to be that market moving either.